Welcome everyone. Thanks for taking some time to join in with us today. My name is David Smith. I'll introduce myself in a little more detail in just a couple of minutes, but I do want to take a second to give you some good news and some bad news. The good news is we're not going to take the full 30 minutes allotted here. We're going to cover the information that we want to get out to you in less than that time. The bad news is the Arkansas Razorbacks will not be allowed to cut their game short this coming Saturday. They'll have to play the full 60 minutes. There's a little inside humor here for us Razorback fans. You may be asking, why does the little boy have his mouth open like he's shocked? Well, a couple of reasons. You see it says celebrating Annuity Month, which was in June, so he's probably thinking, man, you missed Annuity Month, which we didn't. But secondly, he heard Ken Fisher's ad on TV when Ken Fisher said, "I'd die and go to hell before I'd sell annuities." And we'll come back to that in just a second, but thanks again for joining us. So just a little bit about our organization here at the ASA Group. We are in our 41st year of operations, and we're very proud to say that we've been family owned since our founding. We're now in our second generation of leadership. That family ownership does give us the stability that is very valuable in this day and age. No pressure for short-term performance, not trying to impress any outside shareholders. So we're allowed to proceed as a business during the up times, the bad times, and everything in between. We do partner with firms across the country that are producing over $5 billion of annuity premium annually. And that sort of scale allows us to build our own office support staff, which I place second to none, and gives us access to the support staff of our carriers and our upline partners as well. So service is not an issue with our organization. We've got all those bases covered. And we are a solution-focused firm. We do not push product. We're more or less carrier and product agnostic. We take our agents and RR's clients' problems, turn those around, scour the landscape, and then provide solution. So that's the real value add of our organization. We're very proud of that fact. So a very brief background about me. I've been in the financial services industry in one form or fashion for 28 years now. And today, where I spend most of my time and what I enjoy the most is visiting with our agents and registered representatives and RIAs in designing cases which brings a solution to the problems that their clients are facing. I am a registered representative. We have other RRs in our office as well, although we do not wholesale variable annuities or other variable products other than variable universal life. We can be in communications regarding the design of financial plans and the use of variable products and how they may fit with what we do here. So we're proud of that fact, and we like to be able to participate when called upon there. You'll see my contact information there at the bottom of the screen as well, and that'll be presented to you again at the end of the presentation. So now we get to move on to the disclosures. And as far as those disclosures go, the one that I want to get across mainly is that we do not give any tax advice to agents, nor do we give tax advice to end clients. We will be discussing a couple of solutions today that do involve the tax code, and annuities do have their own section of the code, but unless you are a CPA or a tax attorney and that is part of your normal practice, we strongly advise against giving any tax advice to your clients. So when we're thinking about annuities and how they've evolved over time, we really went from simple to what I would call much more convoluted over the last 30, 35 years. Basically, for many, many years and decades, we had a traditional income annuity, which was just the exchange of a lump sum of money for a series of payments, whether over someone's life over a certain period of time. And we've evolved into the traditional fixed annuities, multi-year guaranteed annuities, coming down through variable in the 60s and 70s, index really in the 90s, and then taking off in the 2000s, adding riders to both variable and indexed annuities. And then you can see today the fee-based options that are available, and ultimately we've ended up with the hybrid, which is a kind of a mix of a variable indexed principal protected, setting ceilings and floors. And those products, the fee-based products, obviously require a Series 65 to offer, and the hybrids do require a Series 6 or a Series 7. So what's really been the most pronounced change in the annuity market the last 10 years? I think without a doubt, it's the rise of the indexed annuity versus the decline of the variable annuity. You can see here that basically since 2007, variable annuity sales have been cut in half, down from 184 billion to around 96 billion, while indexed annuity premium has more than doubled over that same period of time. And I've thought about why that's actually occurring, and what we hear from the Ken Fisher ads is that VAs are too expensive, and that may be part of it. Also, we've seen more insurance agents coming into the market versus registered reps, and obviously a Series 6 or 7 is required to sell variable annuities, so index makes more sense, obviously, to the independent agent, and the Department of Labor may have been a factor as well. But I want to look at something else for just a second, too. So we're looking at a chart here of the S&P 500 over the last 10 years, and just by looking at the upslope, one would say, what a great time to be taking risk. And I would agree. It's been a wonderful 10-year run in the equity markets. Obviously, a lot of factors have gone into that run, but it's one of those things that when you look at it, you think, wow, I could do this. You see all the day trading commercials come on. You see all the money managers doing their ads, which makes sense as well. And if you just look at this chart alone, you would think, well, there's no reason at all why variable annuities have seen such a decline versus index, because with the variable annuity, you do have a chance to get a lot of the participation in these sorts of bull market runs that we're seeing right here. But let's take a look at another chart too. So once again, those of us who have been around a little bit longer, the last 10 years, and going to tell the whole story, this chart here goes back and shows us the dot-com bubble of the late 90s, followed by the crash after that, which we saw the S&P 500 decline by about 50%. The NASDAQ was down 80% from its high. We then went off into the 2000s with the housing bubble and all the associated paper that was issued alongside that, and the crash that resulted once again with the S&P rounding here, getting cut in half. And then that's what kicked us off in March 2009 for the last 10 years we've been on. But the baby boomers have not forgotten the dot-com crash. They have not forgotten the housing crash. And I think that's a big reason why we've seen such a rise in indexed annuities and fixed annuities, is the principal protection that's offered, giving some upside to those big up runs, but providing full downside protection to those 2001, 2002, and 2008 type events. So let's jump into an active case here, and I'm going to assume a basic level of knowledge. For those who need more detailed explanations, email, call us after the presentation. We'll be happy to take those. But here's a case we're working on right now with a couple, $971,000 sitting in an old variable annuity. $781,000 of that is their basis, and they now have a $190,000 tax problem that they're looking at if they want to start taking income, if they need to use this for long-term care, whatever the case may be. That first $190,000 is going to be subject to tax. So is there anything we can do about that? And the answer is yes. So you saw from the previous slide, we've got a client with, call it $1 million, sitting in a variable annuity with a $190,000 gain in it. This couple does not have long-term care coverage at all. They're both in good health. They're doing okay on income. They got a high tax bracket, but they want to protect their legacy for their beneficiaries. And the one thing about long-term care, which we should all know, is it has to be paid for from some source. It's going to come from your checking account. It's going to come from your brokerage account. It's going to come from an insurance company if you do have long-term care coverage. Since this couple has decided they want to protect their legacy, and they do know long-term care coverage and services are likely to be needed for at least one of them, they want to look at an option for handling that coverage without substantially depleting their estate. So let's take a look on the next page and see what that looks like. Once again, focused on the solution and not the product, taking the old variable annuity and using Section 1035 of the Internal Revenue Code, we're bringing over $300,000, part of that basis, part of that gain, and purchasing an annuity with a long-term care rider. And you'll see that the annuity has a full death benefit, so the legacy is going to be protected in the event this product is never needed for long-term care. And the leverage that we get is the big kicker here. If you look over in the right-hand column, you'll see that that $300,000 is now converted to over a $900,000 pool of money that's generating a $10,000 a month benefit for 90 months available to both husband and wife. In other words, they can both access that $900,000 pool at the same time. And the tax benefit is when the monthly benefit is used for long-term care services, it is exempt from federal income taxes. So not only is the $300,000 being distributed tax-free, including the gain, if the clients do use up their own $300,000 and go into the extended benefit of $600,000 from the insurance carrier, that is also going to be exempt from federal income taxes. So in essence, what you've done here is you've made sure that an additional $600,000 of this estate will not get depleted due to long-term care and can pass along to the husband and wife's beneficiaries. Okay, so we just looked at a long-term care solution where we can get gain out of old contracts completely free of federal income taxes. But what if the client doesn't need that additional long-term care coverage? They don't need that additional legacy protection. They're not as concerned about asset depletion. They need income, but they would still like to get money out of that contract in a tax-friendly manner versus having that first $190,000 subject to gain. So let's take a look at a different solution. So while Ken Fisher may hate annuities, as we talked about earlier, he cannot provide the leverage as we just showed to you in the long-term care product, nor can he guarantee a lifetime annual income until one person dies, or in this case, two people die. And what you're seeing here is that same variable annuity being 1035'd over. You see that in the first column there, accumulation value $972,000. We're converting that into a lifetime income, let's call it $50,000 a year. But unlike a SPIA, which is going to require the clients to give up control of the asset, we're doing two things here. We are using an indexed product that allows the accumulation value to continue to earn interest, pass along a specified death benefit, allow for additional withdrawals. But at the same time, we're getting tax treatment similar to a SPIA. You can see the $50,000 income payment and the non-taxable income column of $25,000. In the past, that was only available in a single premium immediate annuity to get what we call an exclusion ratio. We now can offer that in the indexed world. This is a wonderful solution for 1035 cases where old contracts have a lot of gain in them, and it's one that we're using in a lot of different cases now around the country. Let's jump to another topic real quick. Americans are living longer, there's no doubt about it. Back in the 60s and 70s, you would not have found annuities that were issuing to people really above the age of 85. And up until recently, you couldn't find annuities issuing to clients over the age of 90. But we now have actually a couple of different solutions for clients over 90. Right here in front of you, you'll see that we've got multi-year guaranteed annuities that we issue to clients all the way through age 93, paying a very competitive 3.3% rate. We've also had the recent addition of a fixed index product for clients who do want to maximize the return. They're willing to accept a zero for a little bit higher interest rate potential. They'll also issue through age 93. And this is a carrier that we do have access to, and we're starting to see more and more cases come along for the 91, 92-year-olds. And we're always on the search for the products that are really niche-oriented that solve a very specific problem. Here's an annuity that will issue all the way through age 100, except you can see if you're in Oklahoma, the max issue age is 85. The intriguing part about this contract is it is totally liquid. You cannot refer to this as a money market annuity or anything else, but in essence, it operates very similar in that funds can be added at any time, funds can be withdrawn at any time as long as you're maintaining a $10,000 minimum account value. And where this has come in really handy is for clients who are looking at a forced annuitization, or they have an old life insurance policy that they just absolutely do not need anymore, or a big premium's coming due, and they need some time to figure out what their options are going to be. This contract can be used to 1035 over, keep funds non-qualified, and give a client some time to determine exactly what they want to do with their funds before being forced to make a decision to take an actual withdrawal. And here's another niche solution that has come along to us actually pretty recently, at least here in Arkansas. It's been available in a few other states. This is a state-limited product, so be sure and call us to find out if you're eligible to offer this product in your state. But this is the only carrier/product I know of that actually requires someone to already be in need of long-term care services before they can qualify. So it's really, when you think about it, for someone who is over the age of 90 in particular, like our topic right now, and is in need of long-term care services, this is a solution that might allow them to avoid further depletion of their estate. It might also allow for the 1035 of a product that does have a gain in it, to where eventually they may need it and they'd have to take withdrawals and pay taxes on them. This is a very niche-driven product. It is individually client designed, but it's one of those products that we definitely want you to know we have in our toolkit here for you to use, and we encourage you to give us a call to talk about it if you have clients coming to mind who are over the age of 65 and who are already in need of long-term care services. You know, I truly enjoy being challenged in this industry, and when a complex case comes through here that absolutely sounds like a no, we're not going to be able to help you on it, gets converted to a yes. And in this case, we've got a 96-year-old insured, and this is an actual case. We're working on it right now. A very ultra high net worth family. There is a major tax problem that they're trying to solve. They do have tax attorneys and CPAs in place, of course, already an irrevocable trust in place holding assets. They need institutional management of their funds, and they have to have at least $15 million of annuity capacity to get this handled properly. And if you were to call most IMOs, the answer is you're going to be told, no way we can get all this done. We can't meet the checklist. That's going to be your normal answer, right? Well, we never respond with a no until we've exhausted every single resource that we have. So what we did is searched and searched some more, made a ton of phone calls, talked to carriers, talked to CPAs, talked to tax attorneys, talked to our broker-dealer, and eventually here's what we got. Our 96-year-old insured and her family will get every one of their requirements met. Working with their tax attorneys, with carriers, we are going to be able to handle the tax issue that's been presented. Working once again with our carrier and with institutions, we're going to get them the institutional management that they desire for their funds. This family can take risk. They can take a substantial amount of risk, and they can pay the fees associated with that. And we're actually going to be using an annuity carrier that will provide well in excess of $15 million of capacity for this family. I love the solution that we've designed for this client, and what I want you to know out there is call us, email us. Our job is to run every single trap that we know of before we give an answer. Once again, this looked like a no just from the beginning, but we're very proud to say that we've been able to turn this into a yes, getting to work on this case actively, and it's a real challenge, and I'm actually enjoying myself a lot with this. Okay, so as we're wrapping this up here, kind of going back to the beginning, you know, we've said that the VA sales have been in a long-term decline. Actually, they've been in a decline for over 20 years when you look at the long-term chart. And for the institutional managers out there, the mutual fund companies, the Wall Street banks, that does mean fewer dollars coming into those firms. So what they've done is they've designed indexes that now can go within our indexed annuities. So you'll see below the Merrill Lynch, Goldman Sachs, JP Morgan, the big names have designed these indexes that can go within our contracts. And I'm pretty well neutral about these. I think some of them can provide some value, especially for someone who may be liquidating a securities type account. They're looking for principal protection, but they want some management in it versus just an S&P 500 cap, something along those lines. These they do have embedded fees, usually 50 basis points, so those need to be disclosed to the end client. But I think over time, these will continue to evolve, and it does give a little bit more of an institutional feel to an index contract. And we discuss these allocations based on each client that gets presented to us. So let's bring our presentation to a close today by allowing me to say this. There are those out there who hate annuities. There are those out there who hate the markets. We're neutral here. We don't think everyone needs an annuity. We don't think everyone needs risk. What we do think our agents and your clients need is individual attention to problems. So we design solutions to problems. And what I hope we've demonstrated today is the power of annuities, how they've changed over the years that allows you to address your clients' needs in a variety of different ways. The main thing to remember, don't remember products, don't remember carriers, anything like that. Remember my phone number, my email address, which is presented for you here again, 800-833-0558, or email me, dsmith@the ASA Group. We respond with time, and we respond with a solution. And ultimately, if we've achieved that, regardless of if we do business or not, we feel good about ourselves, and we think we've fulfilled our purpose. Thanks again for your time. Enjoy the rest of your day.